Hey YouTube, this is Zach with Achilles Financial, and today I'm going to be talking about the relationship between interest rates, bonds, and the Federal Reserve, because all of this is super important and we're watching key levels change, which is having an immediate impact on the growth stocks that saw incredible returns in 2020, and we are seeing them break out over the past week and a half. So we've gotten a lot of meeting data over the past few weeks, including we had the FOMC statement as well as the Powell conversation yesterday where he had the full press release, went through and answered a lot of questions. So today we're going to be talking about a lot of that information because I think that it is super important. So first, before we get started, if you have not, please check out my newsletter down in the description below, as well as we talk a lot about a lot of the information that you're going to be seeing today in the Discord, also in the description. So if you find this content helpful, please consider leaving a like and subscribing, as everything I just mentioned is free. So let's dive into this. First and foremost, the information that I have here on the screen is from TD Ameritrade. We are using their bonds and CDs overview, which if you go into research and ideas, I am on bonds and CDs overview. So bonds and CDs are what's known as a fixed income investment. You are buying a contract, and over the term of that contract, you are going to be receiving a monthly, quarterly, semi-annually, depending on what type of investment you choose, but you'll be receiving a payment over time. I think that that's super important to note because these are not like stocks where I am buying the 10-year at 1.45. If it goes up to 1.50, I am selling it, or I am getting a 1.5% bond at that point in time. So that's super important to know that this is a fixed income conversation. You will be making that purchase at that point in time. So why is this important? Well, oftentimes this is a key inflation indicator where you're going to have the bond rates rise associated with inflation. However, as you've seen over the past 6 months, or at least the first 5 months of the year, we have seen incredible beats every single month for the past 5 months, where the CPI or the Consumer Price Index has actually exceeded expectations every single time. And you can see that this rate for the 10-year has been declining during that point in time. So why is that important? Well, what you see here with the bond rates that we have here, especially the US Treasury rates, oftentimes the average investor is not investing in bonds, or if they are doing so in a retirement account using some form of target date fund. So it's not necessarily tied directly to what a lot of us are doing, especially if you are trading on Tastyworks, on Webull, on Robinhood, or even if you're a Thinkorswim aficionado like myself, then you're probably not buying bonds on a regular basis. Oftentimes what are buying bonds are the larger institutions in the United States. Think hedge funds, think mutual funds, Vanguard, BlackRock, Fidelity. Those are the groups who are buying this, as well as foreign investors. And the general thought process is because this is a safe investment over a long-term period of time. So you can have stock market drops that change a crazy amount, but at least I know I'm going to be getting a set amount of return every single year in a form of a payment that goes directly to my account. And at the end of that point in time, I will be getting my money back. So in the US Treasury example here, if this rate, which is the 10-year bond rate, if I buy this, then every single month I will get some money back. And then at the end, I will get my, if I have initial $1,000 investment, I will get $1,000 back. So if that's the case, then why is the rate not going up whatsoever? So if we look at it over time, we've seen data continue to change over and over and over again. However, we're still not seeing any material differences in the overall prices associated with this. So we see that we've got the rates right here, and I'm looking at this information saying, hey, if this expires on 8/15/28, and you can see the pricing associated with it, why would I give them my money if I think that inflation is at a higher rate than what you see right here? So if we go down, and I'm looking for the 10-year yield right now, 29, 30, 31. So if I'm looking at the 10-year down here below, then why would I be willing to provide them with a 10-year bond rate and we see the total right now is just under 1.5. But why would I provide them money for 1.5 if I think that inflation is going to be higher? So let's take a look at what this would look like. What I have here on the screen is the Consumer Price Index, also known as CPI. This is, generally speaking, the Federal Reserve's inflation tracker. Now, this is the overall consumer price index. You can see that it is always going to be increasing because the cost of goods always goes up. This is the concept of inflation. The last time we saw it go down was actually during the 2008-2009 financial crisis. So what are we going to be looking for? Why is this data important when we're looking at this? So if we recognize that the value, again, think present value cash flow, that the value of $1 today is worth more than the value of $1 tomorrow, then I want to put my money somewhere where it is going to give me a return on investment. That's why you put money into a high yield savings account if you still want access to it. That's why you put it into stocks. And in this scenario, this is why you put it into bonds. However, what I'm going to do is I'm going to change this graph, and we're currently looking at the example of the CPI from the Fred database directly. So what I'm going to do is actually the compounded annual rate of change. So what this is going to do is essentially say this is our 12-month annual rate of change, or essentially how much we expect the CPI to be going up year over year. Now, this is not what's known as the real rate of inflation. However, it is a good example of understanding how much our price increases are going to be. I just want to showcase, again, this is price increase year over year from a compounded annual rate of change perspective. What I want to highlight right here, and maybe if we even zoom this in even more, is that we're currently experiencing north of a 7, closer to an 8% compounded annual rate of change. So what this means is that the value of your dollar, again, not an exact representation, but the value of your dollar is actually going to decrease by 8% year over year. Or a better way to put that, and a more accurate way to put that, is that if you are making a purchase today, that same item next year is going to cost 8% more. So if I go out and I buy a gallon of gas for $3 today, then the expectation is that next year that is going to cost 8% more, or $3.24. Now, gas has a lot of other variable factors, but CPI tracks a lot of information. So if everyone believes, and you see this all over financial media right now, it's all over a lot of podcasts, but if you believe that this data is correct and that inflation is going to continue to be a factor, whether you believe it's transitory or not, short-term inflation still means your prices are going up. They don't come down after inflation. So whether you believe that short-term or long-term inflation, regardless of that, why would you want to put your money into an asset that's only paying you 1.5%? Now, keep in mind that during that point in time, depending on what type of bond that you purchase, if you receive that money back, any of the interest that you make during that point in time, unless it's a treasury bond, you are going to be paying taxes on. So not only are you not able to touch the bulk of that money, but you're losing some of that 1.5%. And if you are a bulk lender or you have a lot of money, again, these are normally multi-million to billion-dollar investments that people are making. So again, not us. But if you see that money, why would you put $1 billion into 1.5% return when most of that money coming back is going to be taking, or at least a third of it is going to be taken from taxes here in the United States? So you're looking at a 1% realized rate of return based on the fact that you are going after 150 basis points right now. So regardless of the fact you think it's safe, you're getting 1% return on your money, which you'd be able to do by going after CDs at most financial institutions, or certificates of deposits, which you could do that on a 1-year basis, 2-year basis, 3, 4, 5, where you can make a ladder for that and basically have that money become accessible a lot sooner. So why are bond rates staying down? Part of it is actual market players. However, there's also another factor known as the Federal Reserve. So let's take a look at what they've been doing. So what I have here on my screen now is the total assets for the Federal Reserve Bank. And you can see that this is an institution that had under $1 trillion in total assets until the financial crisis, at which point in time they more than doubled. They said that they were not going to monetize the debt. They said that they were not going to continue increasing. And they actually began the process of decreasing this balance sheet in 2018. However, with COVID, that skyrocketed. And you can see that we went from $4.2 trillion in total assets to nearly doubling that. This is a record, and this information came out today. You can see 3:30 p.m. today, and that information came out, at which point in time it crossed $8 trillion for the first time ever. This is not the intention of the Federal Reserve. So now they're between a rock and a hard place because they have these record amounts of asset consolidation, and we want to know, well, why has this increased so much? Where is this money going? What is it doing? Well, they also came out where this information is today as well. So what you see here on your screen is the Federal Reserve statistical release. It is not very pretty, and this is just how it comes across. I don't have any control over this, so I apologize for some of the fonts and such. But here's the Federal Reserve statistical release. You can find this on the Federal Reserve website or the FDIC. And we'll highlight the U.S. Treasury secretaries held outright. So out of everything that they own, $4.4 trillion of that is currently sitting in the notes and bonds for U.S. Treasury securities. So there's a lot of money that's tied up in these bonds. So the biggest buyer of bonds is the Federal Reserve, and that is keeping the price lower. Because again, a lot of people out there are not going to be purchasing 1.5% bonds in an inflation environment where your real rate of return is 1%, if not less. I don't know anyone who watches this channel who is seeking to go out and find an investment that is only going to get them 1% return. And here's the important thing, that's 1% year over year for 10 years. You can't access that money. So because of that, that's keeping the bond rates down, because the Federal Reserve knows that if bond rates go up, there's going to be more pressure on them to increase interest rates as well. However, the Federal Reserve is hand in hand with our government in the fact that we have so much debt that interest rates can't go up. Otherwise, we're going to unfortunately be unable to pay down any of that debt, despite the fact that we're really not making any instance of paying it down now. So why do I highlight all this information, or the statement of therefore what comes to mind? Because we know that this is not going to occur or not going to improve in the immediate short term, what type of investments do we need to be looking at? So I'm actually not going to be targeting all of the super high growth that we saw rocket skywards today, but rather what we're going to be going after is I'm looking at miners in particular, in terms of gold and other precious metals, because I think that those values will go up if inflation actually begins to skyrocket. Keep in mind, anything that I'm saying is not financial advice. It is just purely my opinion. But we're also going to be looking at precious metals, but also commodities. So an oil trade that I have been very successful with over the past 8 months at this point in time has been using the leverage fund Gush. However, I think oil will continue to rise in price. The other thing that was surprising to me is the US dollar went up in value today. If I continuously said that we're going to keep printing money, I would expect the dollar to fall. So it will be interesting to see how that all correlates. That being said, everything that I've just highlighted points to the fact that we have a market at all-time highs and a dollar that is expected to decrease in value and commodities that are expected to increase in value. If that's the case, I would like to be long other or foreign stocks. I'd like to look at gold, and I'd like to highlight other commodities which I think will rise in price, which means their stock will rise as well. Although admittedly, I am going to be somewhat cash heavy and potentially be looking to play the short side on some of this high growth tech, which is extending even further past their all-time high valuations. All of that being said, I do still hold a lot of stocks that I think personally are overvalued. So there's going to be a lot of portfolio management. But I highlight all this just for informative purposes. There is a lot of moving parts to this, but it is incredibly interesting, and it's important to know that this is what's going on behind the scenes. So if you find this type of content helpful, please leave a like, especially if you made it this far. I know talking about bonds and the Federal Reserve is not always the most interesting, so I appreciate it if you made it this far. And if you did, please consider subscribing. It's that red button just below the video. So I appreciate all of you. Check out the newsletter, leave a like and subscribe, join the Discord. Thanks. Talk to you later.